Hi guys, and welcome to another week of State of the Market. As you all know, I am Marc Fattore, joined by Jennifer Dolh, and this week we are diving into more finance-related questions in regards to understanding what is going on within the state of the market. So Jennifer, I'll let you take it away.
Great, 3 questions today as always. I know a lot of people want to find out more answers regarding the finance space, and based on our past experience, I guess you can answer these today. Yep. In a rising interest rate market, do you see a lot more of the major banks losing market share of the residential mortgage home lending?
This is a very interesting question, actually. We've obviously got experience in commercial lending, and what we can see is that more and more major banks are actually starting to lose market share. So there was a CoreLogic report recently done a little while back. We will find it and send it out as well, which does indicate that more major banks were getting refinanced out of than getting refinanced into, which is very interesting to see, especially seeing what is going on with rates and so on and so forth. So I think there's a lot of competition with the tier 2 lenders, the non-bank lenders, guys that are a lot more alternative with what they can provide to the market. And it's just about education for the mum and dad investor to get a clear understanding that not all banks outside of the majors are there to screw you down or anything like that. They're there to help you and give you those alternative solutions if you can't obviously get mainstream lending. So interesting time.
Yeah. Another question is now a good time to refinance my portfolio debt, even if I have a fixed rate period remaining?
Again, another great question. Is it the right time? Is it the wrong time? There is no right or wrong answer. I think we can all agree with that today. But more importantly, it's about assessing where you're going to be in the next 5 years, 10 years, 15 years. So, of course, interest rates right now might not affect you, dramatically, but they might in 5 to 10 years' time. Your debt might be reduced. You need to factor in all of these things first before you make that decision. What we are seeing is, unfortunately, some people are falling into categories where they might be on interest-only periods, and then they get tipped over into a principal and interest, and then it does become a lot more unattainable for them to hold on to, especially if it's their home that they live in. So we are seeing a lot at the moment in regards to people, kind of weighing up the options and looking at what the break fees are in order to maybe potentially fix a new component now, even at slightly higher interest rates, but also have that flexibility of variable, so that way there are no break fees, so that way we can stay flexible and fluid, let's say, within a market that is obviously continuing to be slightly volatile at the very moment.
Awesome. That was a great answer, actually. Lastly, there has been a bounce back of auction clearance rates, market sentiment, and overall positivity within educated investors' view on the market. Do you see interest rates fluctuating over the next, flattening over the next 6 months, or even fluctuating?
Yeah, look, to be fair, again, great question. And I do see interest rates probably hitting that flat line very soon. When I say very soon, probably by the end of the year. I am certainly no economist and definitely not giving any financial advice, but I think it's more about understanding that we are starting to see a slight bounce back. Yes, we're moving into a warmer season here in Australia. So of course, we are getting that spring bounce back in our step. Market has been notorious for performing in spring and people coming back out of the woodwork. I think we're also getting over the shock factor of seeing interest rates come up, and that was always going to be the case, where we were never going to fully understand what it would look like in the first month. It would have taken 3, maybe to 6 months to feel a little bit more pain and hurt and say, okay, things need to change. Maybe we should put on the market. Maybe we should get in, or maybe we're not feeling any effect whatsoever. So personally speaking, I think we're starting to see fuel prices coming down slightly. Even grocery items, things like that, they're slightly coming down as well. So with all of this inflation being very, very, in a small way being curbed at the moment, personally speaking, I think we are going to see that flat line. We can't keep driving rates up, personally speaking, forever and ever and ever. I mean, don't get me wrong, we can't have what we had previously, but I don't think we can sustain rates at 3, 4, 5% from the RBA. Again, that's my personal opinion, and that's where I see it, but I think there is certainly a lot of opportunity for investors to at least have a look at what is being presented due to market, rates flattening in due course.
Great.
Awesome.
That was, the final question. I guess if you want to find out more about the finance sector and some answers there, you're welcome to shoot us a DM directly on LinkedIn or comment below. Any other questions, Marc is more than happy to answer them, or even myself. But other than that, it's been your Tuesday State of the Market, and we'll see you guys next week. Take care.
See you guys.